Welcome to the deep dive. We're jumping straight in today, looking at Intel's Q3 2025 earnings. Pretty stunning results.
Absolutely. Massive beat, stock jumped. But there's also this forward guidance setting things up for 2026.
Yeah, a lot to unpack. That stock jump was, what, 6% after hours?
Right. So our mission today is basically to connect the dots, the financials, what's driving it, especially AI, and, well, why the market seems a bit unsure long term despite the great quarter, help you make sense of it all.
Okay, let's start right there with those Q3 numbers. They didn't just meet estimates, they blew past them, which explains that 6% pop. So the core numbers, they use non-GAAP mostly, right?
Yeah, and maybe we should just quickly touch on why non-GAAP. It's what investors focus on.
Right.
Because it sort of strips out the unusual stuff, one-time charges, things like that. Gives you a clearer picture of the actual chip business health.
Gotcha. So looking at that clearer picture for Q3, it looked really good. Non-GAAP EPS, earnings per share, 0.23 cents. That's up 3% from last year.
Okay, 3% growth sounds decent.
But here's the kicker. Analysts were only expecting $0.02.
2 cents.
Wow. Okay, so they didn't just beat, they beat by more than 10 times.
Exactly. That's a huge surprise.
Yeah, that's staggering, actually. And it wasn't just earnings, right? Top line, too.
Right. Revenue, $13.7 billion, also up 3% year over year. And again, beat the consensus, which was around $13.16 billion.
Okay, so solid beat on both lines. The clear takeaway is Intel's back to, making real money operationally and growing revenue again.
But getting there, achieving profitability, that takes some doing, especially on the cost side. What did Intel say drove this, and how's it reflected?
Well, they pointed to a few things internally. Strong AI demand, definitely. Strategic investments paying off. And really tight expense management.
Okay.
And you really see that discipline in the margins. That's where the story gets, well, really interesting this quarter.
Tell me about the margins then, because 3% revenue growth is nice, but margin health, that really shows if they're executing better, right? It's probably the single biggest operational positive this quarter. Their non-GAAP gross margin hit 40.0%.
40%.
40%. Compare that to last year. It was a dismal 18.0%.
18. Wow, that's a 22 percentage point jump.
Exactly. They more than doubled their gross margin year over year.
How does a company even do that in 12 months? That sounds like more than just trimming a few costs.
Oh, absolutely. It's fundamental. It's really two things working together. First, yes, disciplined spending, better factory use, cleaner inventory, fewer write-downs than before.
Okay.
But second, and this is crucial, product mix. They're selling more of the expensive stuff.
Like advanced server chips, high-end client stuff.
Precisely. Higher margin products. That pushes up their average selling price, makes every dollar of revenue work harder for them. That leap from 18% to 40%, it shows they're trying to move away from just selling commodity chips, more towards premium.
That makes sense. Better execution explains the Q3 pop. But, markets always look ahead. Let's pivot to the guidance. Q4, and maybe the bigger picture for 2026. What are they forecasting?
So for Q4, they're guiding revenue between $12.8 and $13.8 billion, adjusted EPS around 0 or 8 cents. That basically matched what analysts were expecting.
Okay.
And one key thing for comparison, that this Q4 outlook doesn't include Altera anymore. They sold off most of that FPGA business in Q3.
Right, so Q4 guidance is pretty much in line. Usually that wouldn't cause a 6% stock jump. So the real story must have been in the commentary, not just the numbers themselves.
Exactly. The most important thing wasn't the Q4 numbers, it was what the CFO David Zinsner said about demand. He basically stated very clearly that demand is outpacing supply right now.
Outpacing supply.
Yes. And crucially, he expects that situation where they can't make chips fast enough to meet orders to continue into 2026.
Okay, that is a powerful signal. If a giant like Intel is supply constrained for potentially over a year, that suggests really strong, deep demand somewhere.
And they specified where. Particularly in AI and these compute-heavy segments, it backs up what the CEO, Lip-Bu Tan, has been saying, that AI is just boosting demand across everything Intel does.
Okay, hang on, though. This is where I get a little confused, maybe. If AI demand is so strong that it's causing shortages into 2026, why was their main data center and AI group, the DCAI segment, actually down 1% compared to last year? Shouldn't that be soaring?
That's a really sharp question. It highlights how complex these cycles are. I mean, the fact that DCI was only down 1% could actually be seen as a positive sign, considering how tough the server market was in, say, 2024 with inventory corrections.
Hmm.
So revenue held relatively steady, but the forward commentary, the demand outpacing supply bit, suggests two things. First, their current server products might be hitting manufacturing limits. They could sell more if they could build more right now.
Makes sense.
And second, the next generation AI stuff, like that Clearwater Forest server chip they mentioned, isn't fully ramped yet. So the huge demand signal is partly for future products. The supply constraint is basically setting them up for potentially massive growth later in 2025 and into 2026 when those new chips hit volume. Demand's running ahead of their current delivery capability.
Got it. That clarifies things. The demand is real, but the current revenue is bottlenecked by supply.
Okay, so financial strong, future demand looks hot. What about the strategic moves? There was some big news on funding this quarter, right? Who's investing?
Oh, yeah, the capital coming in this quarter was pretty incredible. Huge validation, really. First, the government money, $5.7 billion actually received from the U.S. government. That's part of the bigger $8.9 billion CGPS Act agreement they announced earlier.
Okay, government support expected. What else?
Well, this is where it gets really interesting. Corporate investments. $5.2 billion from NVIDIA.
$5 billion from NVIDIA, their competitor.
Yep. And another $2.0 billion from SoftBank Group. Both investments in Intel common stock. Wow, okay, that $7 billion from NVIDIA and SoftBank that's huge. Especially NVIDIA. Why would NVIDIA pour $5 billion into Intel stock? That feels really weird.
It does on the surface, but this is deeply strategic. It's not just a vote of confidence. Think about it. NVIDIA leads in AI chips, right? But they depend almost entirely on TSMC in Taiwan for manufacturing.
Right.
By investing in Intel, NVIDIA is essentially buying an insurance policy. They're securing a potential high-volume advanced manufacturing option in the U.S. outside of TSMC. They're validating Intel's foundry ambitions because they might desperately need that capacity themselves down the road, given geopolitical risks or just TSMC capacity limits. It shows NVIDIA believes Intel's foundry plan is critical, maybe even for NVIDIA's own future growth.
So it's less about competition and more about securing the supply chain for everyone. That makes sense. And this investment ties directly into Intel actually being able to deliver that manufacturing, specifically the Intel 18A node. What's the update there?
Yeah, they gave some solid updates on their big 4 nodes in 5 years plan, crucial for them to catch up. They unveiled details on the next-gen client chip, Core Ultra Series 3, codenamed Panther Lake,
Okay.
and gave a first look at the next big server chip, Xeon 6 Plus block, codenamed Clearwater Forest. And the key point, both are built using Intel 18A technology.
And are they actually making stuff with 18A yet? Or is it still just talk?
That was the other huge piece of news. They confirmed Fab 52 in Arizona is fully operational and actually manufacturing 18A wafers now.
Ah, okay. That's massive.
It really is. It means 18A is moving from R&D into actual high-volume production. It shows they're potentially on track to compete head-to-head with TSMC and Samsung again at the leading edge. That tangible progress is why the government and someone like NVIDIA are willing to put serious money down.
Okay, so let's recap here. We've got this picture of overwhelmingly good news, right? Record earnings beat, a fantastic margin recovery, real progress on the crucial 18A tech, billions in strategic funding flowing in. Given all that, how on earth do we explain the Wall Street reaction? The analyst view seems, well, skeptical.
And that brings us to the big paradox here, the thing that, you as a listener really need to grapple with. Despite all this positive operational momentum, the consensus analyst rating on Intel stock is still just hold.
Hold?
Yeah, like only 2 buy ratings versus 26 holds and 6 sells recently. And even stranger, the average price target, around $29.13, suggests the stock should actually fall almost 23% from where it's trading now.
That makes absolutely no sense. Operations are firing on all cylinders. Demand is exceeding supply. Why would analysts predict a big drop? What are they seeing that we're missing? What's the risk?
This is where it gets pretty complex. It boils down to a critical financial detail. How Intel accounted for that government money, the $5.7 billion CHIPS Act funding they received in Q3.
Yeah.
Because this kind of funding is so new and large scale, there isn't a clear established accounting rule for it yet. It's unprecedented.
So what did Intel choose to do? And why is it potentially controversial?
Okay, so Intel basically treated a big chunk of that government cash as a reduction in their operating costs for the quarter, specifically for their manufacturing arm, Intel Foundry. They're essentially saying the government money directly lowered the cost of building their fabs and making those first wafers.
Right. And what would be the let's say, more standard or conservative way?
Usually, grants like this might be treated as capital grants or deferred income, meaning the benefit gets recognized slowly, amortized over the life of the factory or the equipment, years, basically.
Ah, I see.
By treating it as an immediate reduction in Q3 operating costs, Intel significantly boosted its reported margins for the quarter. It was a direct contributor to hitting that impressive 40% gross margin figure we talked about.
Okay, so if the SEC regulators disagree with that accounting treatment,
Yeah.
it's not just a small note.
Yeah.
It could actually change the Q3 profit numbers quite a bit.
Exactly. It could be huge. Intel stated they are currently consulting with the SEC staff on this approach. But the risk, and this is the overhang casting a shadow, is that if the SEC comes back and says, nope, you need to account for this differently, then Intel might have to revise their Q3 2025 results,
Revise them downward.
potentially significantly downward. Given the size of the funding, $5.7 billion, a revision could be material, as they say in accounting. It could potentially wipe out a large portion, maybe even all, of the operational profit they just reported.
Okay, that explains the analyst's caution.
Right. That uncertainty, the risk of a material restatement hanging over the reported numbers, that's likely why so many analysts are stuck on hold, even with the strong operational story. It's regulatory accounting risk versus operational success.
That makes the whole picture much clearer. So, pulling it all together for you, Intel delivered a huge earnings beat, driven by really strong margin improvement thanks to cost control and selling better stuff. They're forecasting intense demand lasting into 2026, backed up by supply shortages. And they landed massive strategic investments from the government and key partners like NVIDIA.
And that leaves us with the final provocative thought for you to chew on. You've got Intel management sounding super optimistic. You've got proof that their crucial 18A tech is working and ramping up. You got industry giants like NVIDIA betting billions on their manufacturing future because they need it. So is the cautious hold rating from analysts just based on old models that haven't caught up to the AI boom? Or is the very real uncertainty about how the SEC will rule on that complex government funding accounting the single biggest thing holding the stock back right now?
Technology momentum versus accounting uncertainty. A fascinating clash. Thanks for diving deep with us today.